What does $100,000 really turn into? In cash, in portfolio size, in lifestyle? I ran the numbers on SCHD versus SCHG. The difference between the two is $4 million, and when it comes to dividends, a gap of 30 grand in monthly income. In this video, we're putting two of the most talked about ETFs head to head, SCHD and SCHG. Both come from Schwab. Both are packed with high quality companies, but they take completely different approaches to building wealth. We'll break down how each one aims to grow your money, the risks that come with them, and which might be a better fit for your goals. Then at the end, I'll show you a side-by-side comparison of what happens when you invest $100,000 into each. One has the potential to turn $100K into a $9 million portfolio, while the other ends up paying you more than $30,000 every month in dividends. But before we compare performance, risk, and projections, we need to understand what these two ETFs actually are, because while they both have Schwab in their name, they couldn't be more different in personality. Let's start with the Schwab US Dividend Equity ETF with a ticker symbol SCHD. Launched in October 2011, SCHD is built for one main purpose: delivering consistent dividend income from high-quality US companies. It tracks an index of stocks with a proven history of paying, and more importantly, growing their dividends every year. The fund charges a rock-bottom expense ratio of just 0.06%, meaning you pay $6 annually for every $10,000 invested. With over $69.46 billion in assets under management, it's one of the most popular dividend ETFs in the US. If you're the type who likes the idea of getting paid while you wait and sleeping better during market downturns, SCHD is built for you. On the other side, we have SCHG, the Schwab US Large Cap Growth ETF. Launched in December 2009, SCHD takes a completely different approach. Instead of focusing on dividends, it invests in large cap US growth companies, businesses that often reinvest profits to fuel expansion, like tech innovators, market disruptors, and industry leaders that aim for rapid growth. Its expense ratio is even lower at 0.04%, and it manages $46.51 billion in assets. SCHG is for investors who want their money to grow aggressively over time and can handle bigger price swings along the way. Now, to really understand why SCHD and SCHG behave so differently, we need to look at the companies they own and the sectors they focus on. Let's start with SCHD. To really make sure SCHD stays steady and dependable, it follows a carefully designed checklist, kind of like asking, can you prove you've been there for me over time? Here's how it works. First off, SCHD tracks the Dow Jones US Dividend 100 Index, which only admits companies that have paid dividends for at least 10 years straight. It also makes sure they're big and liquid enough, like a minimum market value of $500 million, so you're not stuck with sketchy or sleepy stocks. Then, from that crowd, it selects only the top performers by combining 4 smart measures: dividend yield, 5-year dividend growth, return on equity, which is basically how well a company turns your investment into profit, and the ratio of free cash flow to total debt. That shows how easily a company could pay its bills. The top 100 companies that make the list after this screening get into the index, but there's even more balance. No single company can make up more than 4.5% of the index, and no sector can exceed 25%. That way, you're not betting everything on just one big winner or one shaky sector. And to keep things fresh, this whole section is rebalanced every quarter with a full reconstitution in usually March, meaning they rerun the setup and tweak the lineup based on who's keeping up the standards and who isn't. And that's the reason why you see names like Chevron, ConocoPhillips, Cisco Systems, PepsiCo, AbbVie, Amgen, Altria Group, Home Depot, Merck & Co., and Verizon. These companies are often industry leaders with decades of proven performance. SCHD's sector breakdown shows why it's considered more stable. Now, if we zoom out and look at what types of companies SCHD is leaning into, the picture gets even clearer. Energy makes up about 19%, consumer defensive another 19%, then healthcare around 16%, and technology at just over 10%. The rest is sprinkled across industrials, financials, and a few others. SCHD holds about 103 companies, so it's fairly diversified, but the top 10 make up over 40% of the fund. That means while you're spreading your bets, you're still counting on those big dependable names to do a lot of the heavy lifting. Let's talk about SCHG, because this ETF plays in a completely different arena compared to SCHD. SCHG is packed with high-growth, high-innovation companies. You've got names like Nvidia, Microsoft, Apple, Amazon, Meta, Tesla, Broadcom, and both classes of Alphabet stock. These aren't companies that hand out dividends. Instead, they pour their earnings back into growing, launching new products, entering new markets, and doubling down on innovation. Now, what really makes SCHD tick is the type of businesses it's built on. Nearly half of the fund, about 50%, is locked into technology alone. Another chunk goes into communication services with companies like Meta and Google, and a solid piece sits in consumer cyclical stocks, the kind that tend to surge when the economy's booming and people are spending. So even though SCHG holds over 230 companies, more than half the entire fund is tied up in just the top 10. That's a big deal, because when those top names are on fire, like when Nvidia or Apple has a breakout year, your portfolio can take off. But when they stumble, you'll definitely feel it. SCHG isn't just throwing darts at popular tech stocks. It follows a very structured process by tracking the Dow Jones US Large Cap Growth Index. To get in, companies need to be among the biggest in the US and show real signs of being growth stars. That means SCHG looks at stuff like earnings growth, sales growth, and how investors are valuing these companies based on future expectations. Every quarter, the fund gets a little tune-up, rebalancing to keep things in check. Then once a year, there's a full review where it reevaluates which companies still meet the high growth criteria and deserve to stay. When comparing two ETFs, looking at what they hold is only part of the picture. The real question is how these holdings have performed over time. While both ETFs deliver solid results, their paths to success are very different. In the end, I will show you how all the factors of these ETFs can significantly impact the final value, resulting in a difference of $4 million and $380,000 in annual dividends. But first, the historical performance. Let's start with SCHD. Over the past year, it's delivered a modest 0.52% gain. Not exactly fireworks, but that's by design. SCHD is built for steady, predictable growth rather than chasing big rallies. By contrast, SCHG gained an impressive 27.49% over the same period. That kind of performance reflects its aggressive focus on high-growth companies, especially in technology and communication services, which tend to surge when markets are strong. Over 3 years, SCHD rose 7.97%. SCHG, however, tells a very different story. In that same 3-year window, it has surged 82.5%. Over the last 5 years, SCHD has grown 41.57%. SCHG, meanwhile, has grown a massive 117.54% in that same time, nearly triple the growth. Stretching out to a decade, SCHD has returned 107.55%, more than doubling an initial investment while also providing a steady income stream. SCHG, on the other hand, has skyrocketed 340.69%, delivering more than 3 times SCHD's price growth through the compounding power of its high-growth holdings. Now, clearly SCHG takes the crown for price appreciation, while SCHD's consistent dividends add a layer of return that price charts don't fully capture, especially for investors who reinvest those payouts. More on that later. However, price growth is exciting, but it's important to look at volatility, how bumpy the ride has been. SCHD's standard deviation, which measures how much its price jumps around, is 13.14. That's pretty tame. Its annualized volatility is about 16.18%, so it moves, but it doesn't swing wildly. It's the kind of ETF that's easier to hang on to when markets get shaky. Now, SCHG, it's a different study. Its standard deviation is 16.05, and its annualized volatility is 24.29%. That's more than 40% higher than the average ETF, meaning when markets are hot, SCHG flies, but when things go south, it can drop just as fast. Interestingly, SCHD shuffles things around a bit more with a turnover rate of 29%, while SCHG barely touches its lineup with just 3% turnover. That tells you SCHG takes a buy and hold approach, betting big on the long-term winners and hoping they stay that way. Another factor to consider is compounding. SCHG's higher growth rate mean adding value to the investment quickly. However, SCHD holds its own with the power of dividend reinvestments, which can lead to significant portfolio growth over time. In fact, when it comes to dividends, SCHD and SCHG take very different approaches. Dividends are a cornerstone of SCHD's strategy, while SCHG focuses more on growth. SCHD is a dividend investor's dream. It has a current dividend yield of 3.83%, which is significantly higher than the market average. This yield, combined with an impressive dividend growth rate of 10.77%, makes SCHD a strategic tool for generating income. Over time, this income can compound, especially if dividends are reinvested. SCHG, on the other hand, isn't designed for dividend seekers. Its current dividend yield is just 0.38%, with a low dividend growth rate of 3.79%. This low yield reflects its focus on reinvesting profits into high-growth companies rather than distributing earnings to shareholders. Now let's bring all of this together and see how SCHD and SCHG could perform over the long haul. I'll start with the same initial investment, $100,000. No additional contributions, and project the growth for 1, 10, 20, and 30 years. Starting with $100K in SCHD. In the first year, your portfolio would grow to around $112,000. By year 10, your balance would reach around $313,000, and your annual dividend income would be around $14,000. Then we get to year 20, and now the compounding starts to work its magic in a big way. Your portfolio would grow to roughly $1.1 million, and your yearly dividends could rise to around $67,000. But the real compounding results show up in year 30. At that point, your $100K investment would grow into nearly $4.9 million and pay you an annual dividend income of $386,000. That's almost $32,000 per month in passive income, all without selling a single share. Now, what if you took that same $100,000 and invested it in SCHG instead, skipping the dividends and going all in on pure growth? Let's take a look at how that path could play out over time. After 1 year, your portfolio would grow to around $116,000. As for dividends, just about $400. That's because SCHG isn't focused on paying you, it's focused on reinvesting and expanding. Fast forward to year 10, and your balance would climb roughly to $452,000. By year 20, your investment will be worth about $2 million, and in year 30, your portfolio would hit nearly $9 million. That's nearly double what SCHD would give you in total value. But the catch? Your annual dividend income would still only be around $700. So who's the winner, SCHD or SCHG? On paper, definitely SCHG, but it depends on what you actually want from your money. If your goal is a steady income you can live on, either now or in retirement, SCHD wins. If you're focused on growth, SCHG is your go-to. It can turn $100,000 into $9 million over 30 years. There's no universal best here. The real winner is the ETF that fits your personal strategy, and for many smart investors, the answer isn't either or, it's both. A mix of SCHD and SCHG could give you the best of both worlds, income today, growth for tomorrow. Want to know how to turn a one-time $500 investment into a portfolio that pays over $5,000 in monthly dividend income? Click the video on screen to find out.